Before we get into it, this is not financial advice. I'm a self-taught investor sharing my process. Do your own due diligence. You make your own call. November 3rd, 2025. This stock hit $207. 6 months later, $113, down 45%. Meanwhile, the business posted 85% revenue growth in its most recent quarter, accelerating, not slowing down. One of those two things is wrong. Either the market is overreacting, or the valuation was never justified to begin with. Today we look at every number. You decide. And if you find this useful, the like button is right there. It costs you nothing, and it helps this channel grow. That is how a small channel gets this analysis in front of more people. Palantir, NASDAQ, PLTR, founded in 2003 by Peter Thiel, Alex Karp, and others out of PayPal's fraud detection work. The business is simple in concept. They build software that turns raw data into decisions. Governments use it to track adversaries, detect fraud, and plan operations. Enterprises use it to optimize supply chains, reduce costs, and deploy AI across their organization. Two segments: government, which still drives the majority of revenue but is growing slower, and U.S. commercial, which is the rocket ship, guided to grow over 120% this year alone. The platform they sell is called AIP, Artificial Intelligence Platform. The pitch is straightforward. You have mountains of data. Most of your AI tools do not connect to each other or to your operations. Palantir wires it all together into one operating system. That is the thesis. Government cash flow funds the research and development. Commercial is where the growth lives. The stock went from around $25 at the start of 2024 to $207 by November 3rd, 2025. A near 800% run in under 2 years. Then it pulled back, hard, from 207 to 113, down 45%. And today it is trading at its 52-week low, the lowest point in an entire year. What does the monthly chart tell us technically? The HARSI indicator is at near zero, neutral territory after being deeply oversold during the pullback. That oversold condition triggered a liquidity sweep below key levels, meaning stop losses were hit, weak hands shook out. The trend is labeled transitioning, not broken. There is something important in the volume profile. The majority of historical trading volume sits in the $6 to $25 range. The old IPO era prices, between $40 and $100, there is very thin historical volume. That gap means if the stock loses its current support, it could move fast through that zone with very little to catch it. Support here is psychological and round number driven, 110 to 115. If that fails, the next structural zone does not appear until the $80 to $90 range. The business did not break. What changed is the price the market is willing to pay for that acceleration. That is the gap we are here to analyze. Trailing 12 months through March 31st, 2026. Revenue, $5.2 billion. Gross profit, $4.4 billion. Gross margin, 84%. That is software grade. That is not a hardware company, not a services company. This is pure intellectual property at scale. Operating income, $1.99 billion. Net income, $2.28 billion. Now here is the metric I care about most. Free cash flow, $2.69 billion. Net income conversion ratio, 118%, meaning every dollar of reported profit is backed by more than $1 of real cash. That is exceptional, but we need to take one thing out. Stock-based compensation, $730 million trailing 12 months. When we subtract that from free cash flow, we get owner earnings of $1.96 billion. That is what the business actually generates for you as an owner after paying its people in equity. This is not EPS. This is what the business actually generates for you as an owner. One more note, accounts receivable sits at $1.4 billion, about 98 days outstanding. For a company selling large contracts to the US government and Fortune 500 enterprises, that is normal. Those customers pay on their own schedule. It is not a collection problem. This balance sheet is unusual, in a good way. Total assets, $10.2 billion. Total liabilities, $1.6 billion. Stockholders' equity, $8.45 billion. And the one line that changes everything, total debt. 0. Palantir carries no long-term debt, no short-term debt, none. Cash and short-term treasury securities, $8.03 billion. That is confirmed directly from their earnings release. Quote, $8 billion in cash, cash equivalents, and short-term U.S. Treasury securities. The balance sheet is a fortress. In an era where most high-growth tech companies carry significant leverage, Palantir has built a cash machine with no obligations. That cash position also means no interest expense eating into margins and significant flexibility for buybacks, acquisitions, or riding out any market storm. This is the slide that changes the narrative. Most companies slow down as they scale. Revenue growth decelerates. Margins compress. The story gets harder to tell. Palantir is doing the opposite. In the second quarter of 2025, 48% year-over-year revenue growth. Gross margin, 80.8%. Third quarter, 62.8% growth. Gross margin, 82.4%. Fourth quarter, 70% growth. Gross margin, 84.6%. First quarter 2026, 84.7% growth. Gross margin, 86.8%. Let me say that again. Revenue growth is accelerating each quarter, and the margin on each dollar of revenue is also expanding, both simultaneously. That combination, accelerating top-line growth with expanding margins, is extraordinarily rare at a $5 billion revenue base. It tells you there is real pricing power here, and that the software platform is becoming more valuable as it scales, not less. The founder is still here. Peter Thiel sits on the board. Alex Karp is the CEO and still running operations personally. That alignment matters at this stage. Now let us talk about what the filings actually show. ARK Investment Management, Cathie Wood's firm, held 3.1 million shares as of March 31st, 2026. That is $455 million at quarter-end prices. Their portfolio weighting in Palantir, 3.5%. They trimmed just 3.8% of their position that quarter. A modest rebalance, not an exit. ARK is holding. Now the insider picture. From SEC Form 4 filings, CEO Alex Karp sold 398,000 shares on May 20th, 2026 at around $136 for approximately $54 million. He also acquired 1.95 million shares through option exercises that same day. The net, a large options exercise and partial sale. That is a planned compensation transaction, not a vote of no confidence. CFO Shyam Sankar sold 166,000 shares on the same date, $22.5 million, also paired with a 750,000 share acquisition. This is the pattern you see at high-growth tech companies. Executives exercise options and sell a portion to cover taxes and diversify. The acquisitions tell you they are still accepting compensation tied to the stock. The honest read, founders and executives are still here. ARK is still here. The stock is down 45% and nobody with inside knowledge has walked away. This is the most important slide in the episode. Because with Palantir, the valuation is the entire debate. We use the owner earnings method. No discounted cash flow. Too many assumptions. Just, what would you pay for this business based on what it actually generates after paying its people? Owner earnings trailing 12 months, $1.96 billion. Enterprise value, $263 billion. Current trailing multiple, 134 times. That is the rearview mirror. Now let us look forward. Palantir guided to $4.2 to $4.4 billion in adjusted free cash flow for the full year 2026. Adjusting conservatively for continued stock-based compensation, we estimate forward owner earnings of approximately $3.45 billion. At 60 times forward owner earnings, that is our bear case. Implied price, approximately $90. Down 20% from here, at 90 times. Our base case. Implied price, approximately $133, about 18% upside. At 130 times, our bull case. Implied price, approximately $190, near a double. Current price implies approximately 83 times forward owner earnings. You are sitting between the bear case and the base case today. The math is on the table. You decide which multiple is justified. 3 reasons this could be worth $190. First, the AI operating system moat. Palantir is not building one AI tool. They are building the layer that connects all AI tools to real operations. AIP integrates with every system a large enterprise or government agency already runs. Switching costs are enormous. The data Palantir processes for a customer after 3 years of deployment is irreplaceable. That is a compound moat. It gets harder to leave, not easier. Second, the revenue acceleration tells you the product is working. At $5 billion in revenue, growing at 85%, companies do not normally accelerate. They slow down. Palantir is doing the opposite. That is not luck. That is adoption reaching an inflection point. Third, U.S. commercial is the growth engine that most analysts underestimate. The company guided U.S. commercial revenue to grow over 120% this fiscal year, from essentially zero commercial revenue in the United States 5 years ago to $1 billion-plus run rate. If commercial continues compounding and the AI spending cycle is still in early innings, the government segment becomes the floor, not the ceiling. 3 reasons this could fall further from here. First, the valuation leaves no room for error. 50 times revenue, 98 times free cash flow, 134 times trailing owner earnings. If revenue growth decelerates from 85% to, say, 40%, which would still be exceptional by any normal standard, the multiple compresses violently. At 40% growth, the stock arguably deserves a 40 to 50 times forward earnings multiple, not 80. That implies a stock in the $60 to $70 range. From a pure valuation standpoint, the stock is priced for continued perfection. Second, stock-based compensation is a structural tax on owners. $730 million in SBC last year, 32% of net income. The share count grows every quarter. Palantir's adjusted numbers exclude SBC entirely. Management presents adjusted earnings as if equity compensation costs nothing. It does not cost nothing. It costs you dilution every year. Third, government concentration and political risk. U.S. government contracts are real, but they are subject to budget cycles, political decisions, and cancellation risk. Defense budget reviews, spending audits, or a change in administration priorities could materially impact contract renewals. The company has worked hard to diversify into commercial, but government still accounts for a significant portion of total revenue. Every stock I cover, I measure in gold ounces, not dollars. Dollars inflate. Gold ounces do not. If you are not beating gold, you are not actually building wealth. You are running to stand still. At today's prices, 1 share of Palantir buys 0.0284 ounces of gold. Gold is currently trading at $3,999 per ounce. That is your benchmark. The 6-month check date for this episode is December 24th, 2026. I will pull this number again and compare. If the stock has gone up, but the gold ounce count has not increased, the gain was inflation, not real wealth creation. That is how we measure performance here. Dollars and gold ounces, both. 6 dimensions. Honest scoring. Valuation, expensive. 134 times trailing owner earnings, 83 times forward. The market is paying for years of future growth up front. Risk. Balance sheet, exceptional. $8 billion in cash. 0 debt. Strongest in its class. Pass. Margin trend. Expanding. Gross margin up from 81 to 87% over 4 quarters, while revenue accelerates simultaneously. Pass. Revenue growth. Accelerating. 48 to 63 to 70 to 85% year over year. That curve is the bull case. Pass. Smart money, mixed signal. Founders remain engaged and aligned. Institutional positioning pending 13F verification. Watch. Risk. Elevated. The SBC dilution is structural. The valuation leaves no cushion. Government contracts carry political exposure. Watch. Verdict. Watch. The business is extraordinary. The acceleration is real. The moat is real. The cash position is real. But at today's price, you are already paying for most of the bull case. The margin of safety is thin. The stock is near its 52-week low. But that does not make it cheap. It makes it less absurdly expensive than it was at 207. I will revisit this at the 6-month gold benchmark check. I show you the data. You make the call. That is the Palantir thesis. One stock, one scorecard. Every number sourced from primary filings. If you want to follow along as this plays out, subscribe and hit the bell. Every episode, one company, one honest framework. This is the Think Tank Trader. Not financial advice, just a self-taught investor sharing the process. See you next episode.